When I first started picking individual stocks in 2018, I was heavily influenced by the stock price. I would get all anxious when the stock price dropped and then really excited when the stock price shot up. And I hate to say it, but I would make buying and selling decisions based on the stock price movement and not the business fundamentals. And then I immersed myself in Warren Buffett's wisdom by listening to every single Berkshire Hathaway annual meeting since 1994, twice, and created nearly 1,000 lines of notes in a spreadsheet. And recently I've begun this approach with the shareholder letters. And then I realized that I pretty much had it all ass backwards. So Buffett learned from his teacher, Ben Graham, about Mr. Market as an emotional partner who offers daily prices to buy or sell your business stake. Because remember, buying stock is buying a little piece of an actual company. And Mr. Market would offer this at sometimes irrationally high prices when euphoric and other times unreasonably low when depressed, which really just tells us that we could take advantage of Mr. Market, but we should never use his guidance to make buys or sells, because our success as investors depends on understanding the business better than he does. So in a nutshell, and as Warren says, Mr. Market is there to serve us and not instruct us. Just as I was letting Mr. Market instruct my buying and selling decisions and not the fundamentals of the underlying business. Now, I love what Warren said here from the 1987 shareholder letter when he said, quote, "Following Ben's teachings, Charlie and I let our marketable equities tell us by their operating results, not by their daily or even yearly price quotations, whether our investments are successful. The market may ignore business success for a while, but eventually it will confirm it. As Ben said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. The speed at which a business's success is recognized, furthermore, is not that important as long as the company's intrinsic value is increasing at a satisfactory rate. In fact, delayed recognition can be an advantage. It may give us the chance to buy more of a good thing at a bargain price." And that's pretty much what I've been doing, focusing on the underlying business fundamentals and looking for those wonderful companies with a durable competitive advantage at a fair price. And recently, I've applied this thinking to companies like Starbucks, ticker SBUX, Nike, ticker NKE, and my number one individual stock position, Nexstar Media Group, ticker NXST. All right, what's up? Welcome back. I'm Russ, and remember, I'm just a welder. I've actually been doing this for 26 years now, so this is a passion for passive income that I'm sharing with you. This is for fun and entertainment. Do not, I repeat, do not take any of this as financial advice. But if you are interested in the unique brand of information that we dispense here, I have a free weekly newsletter, and you can follow me on Blossom, the social media investing app, to catch up on any daily trades that I do. Those links are in the description below. So we're going to get into the complete February portfolio update, but I thought it was kind of interesting to preface that and share a little bit of my transitional approach to fundamental investing. I thought it might be a nugget of wisdom you could put in your brain if you ever find yourself getting freaked out by stock price movement. Now, this week has been crazy, so I'm going to show you two Simply Safe dividend cards for the dividend raises that we got. But remember, if you need to check out Simply Safe dividends, you can always get that free 2-week trial with an email address. That's all you need to give them. So hook yourself up and poke around. It's free. Why not? All right, so February brought 2 dividend increases that boosted our passive income stream. Realty Income hit us with a 4.5% year-on-year increase compared to March 2024's dividend, which resulted in an extra $10.61 of PADI, which is projected annual dividend income. And remember, Realty Income is an income investment that has very slow capital appreciation. We're not trying to beat the market with Realty Income. You're buying it for that growing and stable monthly dividend income. Then the Global X MLP and Energy Infrastructure ETF, ticker MLPX, pushed their distribution 5.8% higher, which gave us an additional $8.06 of PADI. And now we're down here. High. So that gave us an extra $18.67 of Patty in the month of February without us having to do anything additional, buying any extra shares. Oh, and also, this is not our entire investment net worth. This is our entire investment net worth. We have 74.2% in funds and 25.8% in individual stocks. Now, I'm trying to get this down to 15% individual stock exposure. It's going to take some time because, hey, the portfolio is starting to get a little bit big, but with new money going in and buying more things like VTI, SCHD, MLPX, it's going to get there. So if the stocks just hit a pause, they keep going up and up and up. So it's making it a little more difficult. But anyway, this is our entire investment net worth, not including any savings accounts, any kids' 529 accounts. This is just my wife's and my investment net worth. All right, so the dividends we received, we'll go through this really quickly, starting with the lowest, then to the most. Agree Realty, $25.81. The Global X MLP and Energy Infrastructure ETF, ticker MLPX, $35.19. Main Street Capital, which is two of our three monthly dividend paying companies, paid us $37.50. AbbVie, ticker ABBV, hit us with $41. Starbucks, ticker SBUX, $47.58. That one I'm a little bit sore about. I thought we were going to get to 100 shares, averaged under $80, and then they had to go and mess it up, firing Laxman Narasimhan and bringing in Brian Nickel, who is the magic man, and everybody's expecting the magic to happen. So they baked in wonderful things from Brian Nickel. So hey, maybe if he stumbles a little out of the gate, we'll get some better prices. There'll be a bit of a sell-off. But either way, we received $56.76 from Realty Income, ticker O. Agree Realty, Main Street Capital, and Realty Income are our three monthly dividend paying investments. And then Nexstar Media Group, $219.48 for a grand total of $463.32 in dividends in the month of February. We had one sell in February, which was Visa, ticker V. And on Blossom, a couple people, when they saw that pop up, they were like, what? You sold Visa? So there's a little bit of strategery to what we did here. We had those 6 shares in the self-directed IRA. Now, the self-directed IRA is a locked account, meaning that we rolled over $30,000 in March of 2020 from our 401k to this at Schwab, this IRA, and you can pick individual investments. You have a lot more flexibility. Hey, you can go all into penny stocks if you want. Wouldn't recommend it, but we did that. We have not added a single penny in now almost 5 years, and it's grown pretty nicely. But the point is that we would like that for more fund exposure, and we decided to sell those 6 shares of Visa, which we bought in September of 2024 at an average cost of $272.76. So we had a gain of about 24%. And again, I just wanted to help balance things a little more in the direction of being allocated to 85% funds. It didn't really matter that much currently, but either way, Visa, fantastic company. And yeah, if I was psychic, I would have held on for a few more weeks and got an extra $60-$70 out of it. But with those 6 shares, we lost $14.16 of projected annual dividend income. And now for the dividend buys, everybody. Starting with the least amount of Patty added, we bought 2 shares of the Global X MLP and Energy Infrastructure ETF, ticker MLPX, at $62.32, which gave us $5.52 of Patty. 9 shares of everybody's favorite dividend growth ETF, ticker SCHD. It's really just a large cap dividend fund. $27.97 we bought those 9 shares at, which gave us $8.91 of Patty. 11 shares of Nike at $73.14 hit us with $17.60 of Patty. I just could not avoid buying more Nexstar Media Group under $150, so we bought 3 more shares of Nexstar at $148.57, which gave us $22.32 of Patty. Without getting too much into it, this is a business that I think is still is misunderstood and underappreciated by the market. I don't think they're as much of a melting ice cube as everybody else does. They are navigating, they're growing free cash flow. They are buying back shares like mad people. They're starting to pay down debt a little more aggressively. But I bought those shares at a free cash flow yield of almost 21%, which is just bonkers for a company that continues to grow its free cash flow year over year. And as of last week's earning report, they had a free cash flow margin of 25%, which was up 19% from the same quarter last year. And the last thing I'll say about Nexstar is, yes, they do receive political ad spend that helps boost sales, helps boost revenue, helps boost free cash flow. And a lot of times in the past, Nexstar struggles in even years, which we just had, and they do well in odd years because remember, in the United States, even years have elections and people expect that Nexstar is going to get a little boost, so buying will happen in the odd years. So I also think that Nexstar has some tailwinds because the midterm elections in 2026 coming up, people are going to get in on that ad spend. Then we bought 7 shares of Realty Income at $54.66, which gives us a patty of $22.54. And then we bought 7 shares of the Vanguard Total Stock Market ETF, ticker VTI, at $299.02, which gave us $25.69 a patty. And then 2 more shares of Harrow Incorporated. They are the the eye care company that I do believe in. I think they have a really good growth trajectory ahead of them. And I think the stock price ran up a little bit too cuckoo, and now it's coming back down. But I want to get to 200 shares. I think I'm at 192 right now. So we're going to get there. But that's my non-dividend investment growth stock. That's one of my favorites right now. Ticker HROW. And that gave us a total patty of $102.58 just in February. February. And that was a net, subtracting what we lost from Visa, of $88.42 in patty. Projected annual dividend income for February. I can't say it. February. So we'll buzz through this really quickly, the portfolio review here. And again, if there's anything you want to look at closer, there's going to be a lot of information on the screen. Just pause the video, zoom in a little bit if you want to see some undervaluation scores or whatever have you. But or go to Simply Safe Dividends and punch them in yourself. Get that 2-week free trial with an email address. Dividend yield 3.57%, yield on cost 4.41%. And with the companies that we do hold, it has a dividend growth CAGR of 5 years of 8.1%, which is very nice. So starting with the least amount percentage of the portfolio, we have McDonald's, 10 shares, which were up 74% on. MLPX, 53 shares at $54.81, which were up 15%. Lockheed Martin, ticker LMT, comes in next. 33.5% gain. Most of these were all up on, looking nice, except there's a couple that are down there. ExxonMobil, 146% gain, 147% gain. That's pretty crazy with a yield on cost of 8.77%. Got those shares of AbbVie up 141%. That's nuts. Yield on cost, the magic of buying and holding, 7.6% yield on cost. And the current dividend yield is 3.14. So quite a substantial difference there for AbbVie. Harrow Incorporated, we're up 58%. Don't pay a dividend. Nike, we're up 4.9% on those 91 shares. First goal is 100 on that. We should probably get there by the end of March. Agree Realty, 102 shares. Should have went heavier into that when it was we were buying it in the mid to high 50s. But either way, look at that, 5.08% yield on cost on Agree. Very, very nice. Starbucks, 78 shares. There we got. I think it's going to come down. Wanted 100 of those, but we'll have to see. But we're up 51%, all on the magic of Brian Nickel. Main Street Capital, we are up 63% on those shares. Yield on cost of 8%. And look at the current dividend yield, 4.9. So that's been very nice run up, as well as Ares Capital, ticker ARCC, where we're up 27%. Yield on cost there of 10.5%. With that current yield, still 8.21. You can get in at this price. Vici Properties, 320 shares of Vici. We're up 7.6%. We'll probably keep adding to those if it comes down a little bit, but it does look like it's reasonably valued according to Simply Safe. VTI, we got 39 shares and we're up 2.1% on those. So that's been coming down, the overall market, and we will keep adding to that as dividends roll in and we can reinvest. Realty Income, 222 shares, and we are down 3.6%. That's the only one that looks undervalued according to Simply Safe right now. And we slowly have been adding to Realty Income, and we may just keep buying 1 share a month with the dividends and reinvesting that way. Visa has just been a monster. 39 shares. This is all in the Roth. We're up 35% on those shares. And hey, our yield on cost is pushing 1%. So Visa raises that dividend very fast. See in that column there, 15% 5-year dividend growth CAGR. So they do raise that dividend hella quick. SCHD, 540 shares, is our second largest position. And we're up 15% on those shares. SCHD, just going to keep buying those because you're buying a lot of companies. And remember, you're not buying the companies in SCHD, which Nexstar is in there, Lockheed's in there. You're buying the methodology that places the stocks in and out. So always keep that in mind when buying any ETF. You're buying the methodology and not the stocks that are in it. And then last but not least, Nexstar Media Group, which we're finally up 6.9% on. After being down a bit, it's been a slog getting through it. So maybe this is the beginning of better things that come with the market, giving it more favorable treatment. And we're currently receiving $900 of annual income from Nexstar Media Group, and they have a very low payout ratio. And then we have $525 of cash just sitting there waiting to deploy on any deals we see. And going back to that 1987 shareholder letter, Warren even says that he admits their fundamental analysis won't always be correct. So even Warren Buffett makes mistakes. But the key fundamental thought is that the fundamentals of the business are what should drive our buying, holding, and selling decisions, not the crazy fluctuations of the daily stock price. Just like Ben Graham said, just like Warren Buffett said, in the short term, the market is a voting machine, but in the long term, it is a weighing machine. So let's focus on those business fundamentals if you're a long-term investor. If you're a trader, then it's all about the stock price. But it's the fundamentals of the business that's going to position us best for long-term success. Let me know in the comments below if you let Mr. Market instruct you. And in this floating little box next to my head, I shared a portfolio rebalance we did in our 401k. And I chased dividend yield, made an 11% mistake roughly at the time of that recording. So if you want to see the rebalance and the mistake that we made in this floating little box, click it and I'll tell you all about it there.